Hello, my name is John Combs. I'm a securities entertainment attorney. I work in a very narrow field of investor financing of independent film, and I've been doing that for about 30 plus years. My entire bio, which we won't go through here today, is posted online at Film Finance Attorney, my website. My contact information is here, so that if you have a question or comment, I'm happy to hear from you. Today, we're focusing on the SEC, Securities Exchange Commission, regulation crowdfunding, and kind of taking a pro and con approach, so you'll have that information. Now, here are the basics. First of all, let's kind of get a lay of the land or a feel for where we are, generally speaking. The regulation crowdfunding, the Reg CF, is just another SEC exemption from the registration requirement. So when people say, "Oh, I'm doing an exempt offering," they don't mean, as some of them think, that they're exempt from all rules. It's just a different set of rules, not unlike a public offering, but less burdensome, generally speaking. So it's another SEC exemption from the securities registration requirement. And there's the three of them that are most often used by independent filmmakers would be the Reg D, Rule 506B, and Reg D, Rule 506C, and then this regulation crowdfunding, which we're focused on today. Now, here are some of the requirements for a Reg CF offering. There are offering limits. You can raise up to 5 million, and I don't know why they did this, but put a rolling 12 in a rolling 12-month period. So that means looking backward from today, the last 365 days. If you've raised 5 million already, you can't raise any more. And so, but if you haven't raised 5 million, you can continue to raise up to 5 million. So the other thing that is really different about regulation crowdfunding is that you have to do all of your your presentations through a single portal, just one portal, and these are registered portals with the SEC, and that you have to go through. And so then, and you also can raise money from both accredited and non-accredited investors, so that's a good thing. Can invest in a Reg CF offering. There are some limits on how much non-accredited individuals can invest every 12 months, and there's a little bit of a complicated calculation there based on their annual income and net worth, and of course, presumably the online portal will help you do that. They say you can advertise, but as we'll see in a moment, it's very limited. And overall, the regulation CF is designed to allow small investors to invest in small offerings. And so that sounds like a good plan or a good idea. Now, there are some specific disclosure requirements. You will have to have a securities disclosure document, so to speak, just as you do with any of the other exemptions. For example, when you look at it generally, you say, okay, there's a series of disclosure documents associated with different types of offerings. For example, a public offering, a registered offering, you would use a prospectus, and I still see people today going around saying, "Oh, well, let's talk about using a prospectus." Most independent films are not going to do public offerings. Only 3 have been attempted in the last 30 years, and none of those have been successful. They're too time-consuming, complex, and expensive. So most independent filmmakers are relying on one of these 3 exemptions that we've already mentioned. And each one has its own disclosure document, securities disclosure document. So the prospectus is associated with a public offering. A PPM or private placement offering memorandum is associated with Reg D, Rule 506B or 506C. And they call the security disclosure document used in conjunction with regulation crowdfunding an offering statement. So that's a little different. It's just different name for different securities disclosure documents. So you do have to have a disclosure document, which means you're going to be disclosing information to your prospective investors. So here's some of the specific information that's required to be disclosed to prospective investors for a regulation crowdfunding offering: name, legal status, physical address, and website of the issuer. The issuer is going to be your production company, or in most cases, a manager-managed LLC, which is the investment vehicle. Names of directors and officers and investors with 20% plus ownership. Now, this is your first clue here that the Uh, Regulation CF disclosure requirements are oriented toward corporate stock offerings as opposed to manager-managed LLCs, whereas most independent film offerings are going to be manager-managed LLCs. So you have to do a little bit of interpretation and as you go through this. Description of the issuer's business. That's similar to what you see in a PPM. Description of financial condition of the issuer. Does it exist, and when was it filed? When was it formed? Who are the owners? That kind of stuff, and how it's set up financially. Target offering amounts. Usually we do minimum mini maxi offerings, or minimum offering proceeds, up to a maximum offering proceeds. And then a description of the purpose and intended use of proceeds. We have a whole section of the PPM for use of proceeds. Price of securities or method for determining the price, the terms of the securities, and how to exercise those rights. That, again, is more corporate speak and mostly associated with corporate stock offerings. Now, what did they leave out? Well, what we have here is a basic form, a Form C, which is really only 26 pages in length, drafted primarily by people who work at the SEC and don't necessarily know anything about the film industry. And it's not even designed specifically for the film industry. Regulation CF is for all startups who want to raise money in this manner through this exemption from small investors. And so naturally, they don't talk a lot about, well, what kind of specific film information do we need to disclose? But here are the kinds of things that are not specifically asked for in the Form C, which typically we would see in a disclosure document, a PPM for a 506B and 506C if you choose to do so. But as you recall, 506C has no specific disclosure requirements. You're only relying on the anti-fraud rule, which applies across the board to all securities offerings, and basically says you must disclose all material aspects of the transaction. And so these are bits of information, sections in a properly drafted disclosure document that fully discloses all material aspects of the transaction. So you've got script synopsis. I mean, how could you possibly approach investors about investing in a film without letting them see a script synopsis and a log line and the film genre and narrative bios of key people attached? I mean, you got to be kidding. Investors want to see who's attached to this film, who's going to be the cinematographer, who's going to be the director, who's going to be the producer, maybe who some of the actors are. Box office comparables. I mean, come on, you want to approach an investor and not let them look at your opinion about some past films that you think are similar to your film and how they performed at the box office? No. I mean, you want to include that information, but Form C doesn't ask for that. It's a more generic form. A target audience analysis, production strategy, production schedule and timetable, marketing and distribution options. What are you going to do with this film after you complete it? How are you going to market it to distributors? And what are your options? And what do you favor? What do you think is probably the approach? Plan of distribution of units. How are you going to sell these units? Is it going to be issuer sales, which is typical, or broker-dealer sales, which is not typical, and then compensation of manager and affiliates. I mean, if you are raising a small amount of money, let's say $500,000, and you're going to pay yourself $150 of that because you're the producer, director, writer, and maybe one of the actors and the editor, and I've seen that happen. You're going to pay yourself $150,000 out of that budget before the investors ever see a dime. That's kind of iffy, and investors might turn away from that kind of deal. So that's important. And you leave something out like that, you could get in trouble. What's the revenue sharing ratio between the investor group and the manager LLC? Allocations and percentage participations. A summary of the LLC's operating agreement. You get a longer document like this, the SEC wants you to at least provide a summary of the operating agreement. When you're going to provide reports to unit holders and what the contents of those reports might be. Whether or not there are any pending legal proceedings. I mean, if you got sued for fraud 3 years ago and you didn't say anything about it to these new investors, they could come back on you and say, oh, you left out something material, something important. That's securities fraud. The LLC operating agreement itself, and then financial projections if you choose to use them. I have another video on financial projections. So those were things that the Form C leaves out. Another specific disclosure required by Form C is the financial reporting, the financial statements. So you'll see they have 3 different tiers. If you're raising up to 124,000, your financial statements need to be certified by the issuer's principal executive officer over the last 2 most fiscal years. If you're raising in the middle level, there were 124,000 to maybe 618,000, your financial statements for the last 2 years need to be reviewed by an independent public accountant. That can cost a little money too. If you're raising over 618,000 to up to 5 million, you're going to have to get an audited financial statement by an independent public accountant. That could, be as expensive as $25,000, depending on how much money you're raising in the company. So you've got a 3-tier system for financial reporting, which is more extensive than either the Form D or Reg D type offerings. Now they say you can advertise, but then they come back and say, well, not very much. We're just kidding. So you cannot, in a Reg CF offering, you can't advertise specific investment terms publicly, and all offers and sales and basic offering disclosures must be presented exclusively on that chosen regulation crowdfunding portal, nowhere else. Now, once the Form C, which is your basic disclosure document for a Reg CF, once it's filed with the SEC, the issuer can't publish the detailed terms of any form of sales presentation on other sites or social media. And any communications other than those presented on the chosen portal are restricted to basic, what are called in SEC terminology, tombstone notices that only name the company, the state from which the issuer is conducting its business, and a link directly to that portal. So you can see they're saying, well, you can advertise it. That's a real big advantage. But on the other hand, the only thing you can advertise in other places other than the portal are the name of the company, the state from which the issuer is conducting its business, and a link directly to the portal. So you're trying to drive traffic to that portal. Now, on the other hand, regulation crowdfunding tombstone notices can be placed anywhere, including on social media, websites, email, newspapers, and television. So it's kind of like, we give you this and take away that and give you that, who knows. Now, finder rules. Under regulation crowdfunding, unregistered finders are prohibited from earning transaction-related remuneration commissions, which is what finders typically want. And so I have another video on YouTube about finders' fees. And those rules are pretty extensive. So you might check that out. Since the regulation crowdfunding offerings are open to non-accredited investors, members of the general public, the SEC enforces these rules to prevent unregistered individuals from acting as illegal broker-dealers. That's the point. Finders typically are not registered. There are a few states that allow them to be registered, but typically they're not, and they're not broker-dealers. But if they're acting like broker-dealers, the SEC is going to come after you. And you, as the producer, can be guilty of aiding and abetting. Now, I have another video on finder rule for finder fees, so you might want to check that out, part of the same series. Now, there are restrictions on the resale of these securities, just as there are in other exempt offerings. Investors face resale restrictions, meaning the purchased securities generally cannot be resold at least for 1 year. And some refer to this requirement as a 1-year lockup period, but basically it means that investors cannot, and from the other side, should not be encouraged to purchase these securities with the intention of reselling within a year, except under very limited circumstances. Now, one other requirement for regulation crowdfunding is that any issuer whose founders are major shareholders, again, any of them have a history of securities fraud or related violations, they can't participate. Those are called bad actors, and so they can't participate. Now, I think the disadvantages of regulation crowdfunding is the multiple required filings. With Reg D offerings, 506B and 506C, you only have 2 or 3 filings at most. Here you could have up to 6. Form C is the basic offering statement, and that's what you start your offering with. And it must be available online for at least 21 days before the issuer can accept investor funds. So that's a little requirement. And then there's a Form CA, which is an amendment to the Form C. And then there's a Form CU, which is a progress update. We don't have that with Form D and Reg D. But that's a progress update, and a Form CR, which is an annual report. So you have a progress update plus at the end of the year, you have to make an annual report. And then there's an annual report amendment, which is a Form CAR, and then there's a Form CTR, termination of reporting. That's what you're in your offering. So lots of reporting. I don't know why the SEC thought that was necessary, but for small offerings, but they chose to do so. Okay, now we're going to shift gears a little bit and talk about getting a kind of an overview of the so-called regulation crowdfunding community. As of this year, for example, 93 operational regulation CF funding portals were registered. That's a lot. And that number changes from year to year. So, but most of them only offer so-called general investors. In other words, one of the advantages, supposed advantages of a Reg CF offering is that you have investors already signed up with this portal, and you choose that portal, and then there are a certain number of investors. Now, the question is, how many of them are so-called general investors who may or may not be interested in independent film offerings, which are considered to be rather exotic or risky? So, it's hard to know. And there are not very many of these portals that are focused. There are none that are focused on independent film offerings, feature film offerings by itself. There are a couple who do film, television, gaming, digital media projects like Cineblock Films, but they've been only operational since January of this year. And there's another that's older, Republic Films. They started out with tech startups and real estate doing the regulation crowdfunding offerings, and then added offerings for movie, TV, and video games in 2024. So a couple of years there. And then there's the bigger general regulation crowdfunding portals like WeFunder, and they sometimes do or they handle independent film campaigns and other entertainment projects. They became operational in 2016 when regulation crowdfunding went into effect. And Start Engine, another one, again, mostly for general investors. You don't have any idea whether any of those people would be interested in an independent film type offering. But they also say they raise money or do raises for independent film. They became operational in 2016. Now, here's some information about enforcement. Since the first regulation crowdfunding portal became operational in 2016, at least 15 to 20 registered funding portals have faced major enforcement actions, including regulatory fines, suspensions, or outright expulsions by the SEC or FINRA, the Financial Industry Regulatory Authority. Seems kind of incredible, but it's a new law, and people are jumping on boards and trying to get in there. 93 registered portals now. I don't know, maybe more or less next year. We'll see. But in other words, about 21% of those portals ran afoul of the law in some manner. Now, that could cause a problem for you after you've paid your fees and so forth, and you've started an offering, and the portal gets fined or it can no longer operate. So that's an additional risk, I suppose. Now, let's talk about fees. Regulation crowdfunding portals typically charge a combination of cash commissions, equity fees, and onboarding costs to the issuer, you the producer, your public production company, in addition to minimal processing fees for investors, so they get paid on both sides. And not all regulation crowdfunding portals require upfront or onboarding fees, but many do charge them to cover costs associated with their due diligence of you and setting up the offering pages on their site. And these sometimes can be deferred, apparently, until the closing of the offering. So that's something to consider when you're negotiating these fees. Total commissions, though, and fees for an issuer typically range between 8.5% to 13% of the gross proceeds raised. So, for example, if seeking to raise $500,000, these fees could reach as much as $65,000, 13%. A little pricey, it seems to me, but maybe it's worth it. We'll see. Now, one of the things I've discovered is that a lot of these crowdfunding portals are not all that transparent about certain issues and information. Many do not disclose the number of film offerings that they've conducted. Or more specifically, they tend to not to distinguish between feature, documentary, or short film. So if you're doing a feature and you ask them, how many films have you done? And they say, well, I've done 100. Well, then you ask them, well, how many of those are features as opposed to documentaries or short films? And they can't tell you that, or they won't tell you that. And I think it's really important to ask the question, how many, if you're doing a feature film offering, how many feature film offerings have you conducted? And go ahead and ask them the next question, how many of those offerings were successful? I'm not saying the film was successful. I'm just saying, was the offering successful? And, if they can't or won't answer those questions, that's a red flag. Now we're getting into some discussion areas where just something else to consider. Reasonable minds may differ. And that is, which is more effective? Which is a more effective selling document or compliance document? Because these securities disclosure documents do both of those things. They serve as selling documents and compliance documents. So let's look at Reg CF, an offering statement. The SEC's Form C is 26 pages, maybe that's with instructions and blanks, and maybe you add some addenda or exhibits. They then with the private placement offering memorandum associated with Reg D, 506B or 506C, you may have maybe 100 pages with including the LLC operating agreement and possibly financial projections if you choose to use them. So a lot more information usually in a Reg D, and we saw that back before when we said, what do they leave out of the Form C? So clearly, as a selling document, you're giving more information to investors with a PPM as opposed to a Form C typically. And presumably then the investors would be more interested because they've got more information, and that's what they need. And then as a compliance document, clearly you are less likely to be sued or get some kind of enforcement trouble if you provide disclose all material aspects of the transaction, which is what a PPM is trying to do. Whereas the SEC's Form C is more of a minimal disclosure document. And I'm contending that it's a safer bet with a PPM that fully discloses all material aspects of the transaction, as long as it's accurate and you haven't left anything important out and it's not misleading, that you're safer doing that from a compliance standpoint. But again, that's open to people's opinions. And here's some related questions. Is less disclosure in Form C more or less likely to result in a lawsuit or complaint by a disgruntled investor than a properly drafted PPM? My opinion is yes. The more disclosures in a PPM, if accurate, complete, and not misleading, are less likely to result in a lawsuit or complaint by a disgruntled investor. So that's something you have to consider. And we talked a little bit about this earlier. What happens if a Reg CF portal goes out of business after you pay the onboarding costs? Well, they're not operating anymore. So I'm not sure exactly how that would be handled, but certainly the offering is over at that point, and you'll have to move to another portal if you want to do that again. Okay, now as I went through creating the slideshow, I sort of created a list of decisions to be made by an independent film producer who chooses to go this route. And so, first of all, of course, before you even get to regulation crowdfunding, you have to decide, okay, which exemption from the registration requirement will you rely on? Is it going to be Reg D Rule 506B, Reg D Rule 506C, or regulation crowdfunding? And if regulation crowdfunding, which is what we're focused on today, which of the 93 registered portals will you use? Of course, that number is going to maybe be up or down next year. We don't know. And so, that there's some work involved there in just making those preliminary decisions. And that next, do any of the portals you're considering have a history of enforcement actions, including regulatory fines, suspensions, or outright expulsions by the SEC or FINRA? That's part of your due diligence, okay? Just don't go into this blindly. And what are the target amounts for the offering? That's typically what you would do in any of these exempt offerings. And where do you plan to advertise the link to the portal, which is the only thing you can advertise? And how do you appropriately complete the Form C with whose help? If you need help, and at what cost? I mean, the portal might provide some help. An outside consultant might be needed at some cost. A securities attorney with entertainment experience might be needed at some cost. You have to make those decisions. What additional disclosures beyond those specifically called for on Form C, which seems to me completely inadequate, are advisable? And you have to make that decision. What level of finance? And we talked about, all the information about film offerings that have been left out of the Form C, which is understandable again because Form C is really for general type investments. What level of financial statement review will you use, and at what cost? Independent accountant reviews or audits might cost as much as $25,000. So you need to know that in advance before you make this decision. And of course, that's determined by the amount of money you're trying to raise. And then, do any of the founders or major unit holders in your production group have a history of securities fraud or related violations? So you have to do some due diligence on your own team. And do any of the portals you are considering have a history of major enforcement actions, including regulatory fines, suspensions, or outright expulsions by the SEC or FINRA? More due diligence. And then what are the portal fees and costs? Who pays and when? So you need to really dig into that. Are the portals you've chosen being upfront and honest about how many feature or documentary films they have handled, and how many were successful in terms of raises? I don't mean successful films, I mean successful raise. And are you willing to accept the greater risks associated with less disclosure of Form C? Form C clearly provides for less disclosure, minimal disclosure, and if you're willing to go along with that and accept the added risk, that's your call. So good luck with that. Now, unfortunately, none of these considerations address the elephant in the room, the lack of accurate accounting or outright corruption by film distributors. For further discussion on that important issue, see my book, The Feature Film Distribution Deal. Now, as I said, this is a series of videos that I'm doing relating to independent film offerings. Other topics in the series include what is a security? If you have questions about that, hopefully that'll clear that up. And then securities compliance is kind of an overview of securities compliance. And I think there we go into a little detail about Reg D 506B and 506C. And then the disclosure controversy. How much information should you give? Or some look at it as what's required, and others look at it as, well, what information should you give to investors to encourage them to invest? And then there's a video about financial projections, often referred to in the industry as waterfall, which is a term I think is misleading. And then there's a video about finder's fees, one on business plans, their use and abuse, and then what happens if you fail to comply with the securities laws. And of course, if you don't even know you're selling the security, you're not likely to be making any effort to comply. So that's, let's say 1, 2, 3, 4, 7, 8. And with this one is 8, all total. So that's the presentation on regulation crowdfunding, and I hope you find it useful. And good luck.